Welcome to the ARMR Report. Welcome to the morning meeting, everybody. Thanks for joining. We click on in to get to the ARMR Insider section of the website. There we are. We're going to go down to the captain's log, and we're going to discuss what we think is happening in the stock market today. I always type that out for you first, and it took me a little more time to get ready. So this morning's call is at 8:45. Thanks to all of you for joining me. I hope you had a great 4-day weekend. That ridiculous half day of market trading on Friday, I hope didn't ruin your weekend. So let's just jump in. Every morning meeting, the object here is to get ourselves ready for the trading session and to, tap our goalposts, if you will, if it's a hockey term, but tap the goalpost, right? We're a goalie. We're going to make sure we're in the right position to address our day. So as usual, I'm sharing with you how I manage my own personal capital. I'm taking 30 years of experience. I'm sharing with you what I've learned over those years. And then day to day, I share with you the successes and the failures and hopefully make all of us better traders and stewards of our own capital. That's the point here. So whatever I'm saying to you, you always have to figure out your own risk tolerance, your own goal, and then make a decision for yourself. Do your own due diligence. But step one of the ARMR report, right? There's, I would say step one is really the algorithmic approach. So the ARMR investing way, is a 3-stage process. We build our whiteboard, which is fundamental research. We use algorithms. Those have been designed over the last decade to help us decide when to add capital to the market, take risk, when to take risk off. And we use stop losses to protect ourselves from ourselves. That's the process. But when I come in every morning, the first thing I do is I look at our swing trading algorithms on the big indexes, which make up the risk monitor. Right. So the risk monitor has simple green, yellow, red structure to it. Right now we're risk monitor yellow. All right. So risk monitor green, we can go take a peek at the S&P so you can see what I'm talking about. So risk monitor green happened right here. The market popped up and had this little down, nothing. That didn't change anything. But right here, I guess we can all do this together so we can see where this happened. The risk monitor changed to yellow right here. Okay. So we'll just fill color that yellow, right? So that was the change. We saw a little double top in the reversal right there. And we looked at our indexes. And most importantly, we had one of our 7 indexes fall off of the ARMR index portfolio. So what we do is we run money in 4 separate ways here at the ARMR report. ARMR Portfolio 1 is geared towards the whiteboard, buying individual stocks when algorithms tell us to put money to work and then using stop losses to protect, right? Portfolio 2 is geared primarily for the, only for the algorithms. We own the indexes there. So we use our swing trading algorithms to own indexes in that portfolio. And then we have a large portion of the capital dedicated to intraday trading of the indexes using our day trading algorithms, right? And then a sliver of that portfolio we use for specific group ETFs that we want to own in the portfolio. Like for right now, we own the cannabis ETF, MSOS, and I'll look at that in a minute. The third portfolio, and not particularly in any order here, this is just 4 portfolios. The third portfolio is our index only. So in that portfolio, when we get risk monitor green, we buy all 7 indexes. The NASDAQ, the S&P, the Dow, the small cap. Those are the big 4. And we have momentum, value, and the IBD 50. So part of what changed the portfolio, the risk monitor to yellow, is that one of those 7 gets stopped out. And that's what happened. I think it was early last week or the week before. Right here where we saw the innovator stocks, IBD 50, okay, put in a double top and crater below the 50-day, and it took us out of our position. Okay, so we switched to risk monitor yellow, which is still a bullish position, but it tells you risk is higher. And so, what I want to share with you is we go back here for a second. We go to the captain's log. I suggest you all try to take a peek and read this from time to time so you can, take these discussions and see them written down, right? So you can always reference back to them. So I wrote to you guys right here, I've raised the stops. And with risk monitor yellow, taking everything out that's non-performing, taking everything out that's non-performing. So before anything happened on Friday's half a day, we already at the ARMR report raised a lot of cash. When we go risk monitor yellow, it doesn't tell me to take everything out. Risk monitor red, I go to cash. Okay. Risk monitor yellow tells me let's rally around our best positions. Let's cut out non-performing assets. Let's raise our stops. Okay. If the market wants to keep charging higher, we keep making money, but we have maybe a cash position we're holding. And in this particular case, the cash position we're holding is close to 70%. So before the market cratered on Friday, we already had 70% cash in the portfolio. Now that's a higher percentage than normal because I've also described to you all that I'm in the process of changing my whiteboard, okay? And the way I build that whiteboard. And I'm going to share that with you guys, not on this call today, but still working on that. That might be something we discuss more in December. So we're ready for 2022. But so I was a little more aggressive in those portfolios, and we're carrying about 70% cash. So we come into Friday. The market's cratering on pandemic news. I have a couple thoughts about that. Number one, and any ARMR insider can attest to this, right? I wrote for you. I wasn't on the desk on Friday, right? I left the desk, took a 4-day weekend, but there I am texting in a couple of things to the Slack room for those of you who were in there. Okay. And bottom line, what I was saying on Friday is number one, I don't trade Friday. I don't change positions Friday. I don't day trade on a half a day, and I don't change positions on a half a day. I don't let my stops get triggered on a half a day. Half a day action is notoriously volatile. Big money's not there. Big money's in the Hamptons. Big money's having fun for the weekend. Okay, so you get an algo-driven market. The market starts to head lower. Algos are reading the tape. They're reading stories about pandemic, and the market starts to implode, triggering stops, and then people just panic, and there's nobody around to support the market. That's why I don't day trade. So normally the market's down big at the open, and I'm telling you guys, hey, let's get out there and capture alpha and put on a nice day trade. There was no day trade to be had. And there usually isn't, because when the direction gets started on a half a day, it just keeps on going until 1 o'clock. There's no one around to change it. The normal behavior that you see on a normal day doesn't happen. Okay. So, it doesn't change my stops either. And so let's go over stops for a minute. Normally, let's say on the indexes, the 50-day moving average is typically the stop if we look at the index algorithms. Okay, so let's go take a peek at the indexes for a second. Okay, well, so first of all, the 50-day got violated on IBD 50. We were already out of that position. But let's look at what happened to the Dow. Okay, craters through the 50. So you're going to say to me, well, why aren't we taking this position out of the portfolio? Okay, two reasons. Number one, the ARMR algorithms do not allow half days to take them out at stops. So if it drills through the 50, we start looking at the next logical stop. And the next logical stop is 200-day moving average, and we're not that far away from it. The same thing is true about the small cap index. We get driven down below this level here, right to the 200-day moving average. You're already there. It's already happened. There's nothing to do now except for to use the low of that day, which is also the 200-day moving average, as the stop on the position. Meanwhile, the two most important indexes are not violating the 50-day. The S&P is above the 50, and so is the NASDAQ 100. Okay? So the S&P and the NASDAQ really drive the bus. The Dow and the small caps are secondary, but still part of the big four. So in order for us to go to risk monitor red, in all likelihood, we're going to have to see a weekly violation at the end of this week that takes us out of the market. Okay? The likelihood of that, I don't know. We're all just spitballing here. I have no idea. I use algorithms and I execute. But my guess is that's not going to happen. This is the right time of year for markets to go up. And let me just tell you this. Markets love to look back at prior problems and have vicious shakeouts. But the reality of the situation is it's very rare that what happened yesterday is going to drive the market exactly the same way tomorrow. Example, 2008, the market crashes on financial issues. And then all through 2009, 2010, 2011, I can't tell you how many times the market would shudder because there'd be some ridiculous story rehashing what had happened in 2008 that never came to fruition. Anybody who reads Zero Hedge can tell you that, right? For Zero Hedge feeds, they're like a bottom feeder, okay? They feed off of fear, okay? So after the financial crisis, like every other month, they had a story out of another financial crisis that's about to happen. And first of all, they were wrong on all of them. And second of all, the market just doesn't, it can have a short-term reaction because there's fear and you run stops, okay? And there's algorithmic trading. But over the next couple weeks and months, the market doesn't respond the same way it did the last time, right? So 2020, we didn't know what a pandemic was. It hit in February. The market imploded through March. Okay. Can that happen this time? Sure, it's possible. It'll take us out of our stops. We'll go to cash, okay? But what I'm saying is the probability that another pandemic is going to crater the market is infinitesimally small. There'll be something else that craters the market. You want to worry about something? Let's worry about the Chinese real estate market, which is literally imploding. That's something worth worrying about. We could talk about that on another conversation, okay? And does that implosion that's probably set to accelerate in January have a really negative impact on the rest of the world? It may, I don't know. So if you want to talk about something that's out there that might put the market down, let's do it. All right. But let's don't pretend that another variant is going to cause the same type of response that we had in 2020 when nobody understood what a pandemic was. Okay. It's just two totally different things. So these are my thoughts this morning. I use stop losses. I use algorithms. So I'm giving you my opinion on what I think the market's going to do, which is to rally to the end of the year. And this is just another shakeout along the way. That's my opinion right now. If we get taken out of stops, if the market implodes again and S&P and the NASDAQ go below the 50-day moving average aggressively, hey, I'll be raising cash. I already have 70% cash. So it makes it very easy for me to have this conversation with you, right? If I was 100% invested right now, my head would be like spinning. Market cratered, now it's rallying, right? But we already have a lot of cash. We're already protected. We can follow the strategy to the natural conclusion of the stop. That's what we're doing here at the ARMR Report. In the meantime, a lot of research is going to go into the whiteboard as I continue to change the names that I want to focus on in 2022. As I just gave you a little hint of this last week, I only want on that whiteboard names that I think have open-ended potential. If it's a company that fits into a big index, I'd rather own the index. I'd rather own 2 or 3 times the index. Then I have no individual stock risk and I can still make money on the idea. It's not that an individual name can't work that's in the index. Feel free, go buy it. But for my whiteboard, I want it full of names that are not reflected in an ETF that have massive upside potential. Okay, metaverse names is an example. U.S. cannabis names is an example. These have unbelievable upside. Doesn't mean I go buy them today. The whole point of the whiteboard is to build a list that you've done due diligence on, that you've done your research on. So you're ready to put the money to work when the market lines up and you get the algorithmic entry point, right? That's how we run money here. So I'm loading my portfolio, my whiteboard up with names that I want to own that I think have open-ended potential. Some biotechnology names are going to go on that list. Okay. So to wrap up my thoughts right now for you, and just another quick review. And you can see them right here. I've just written them in, right? So couple quick thoughts as we look at the S&P again. Cryptocurrency is a lead indicator of risk-on trades. I tweeted this out last week, and I just want to make sure everybody understands what I'm saying. This is not a comment on whether or not crypto is a great idea or a great investment. I just want to make sure everybody understands what they own when they own cryptocurrency. It is not a hedge against a market decline. People like to pretend that it's the new gold. It's not gold. It's got nothing to do with gold. It's completely different. The people who own cryptocurrencies own them for a completely different set of reasons. When the market plummeted on Friday, crypto was leading the charge lower. Gold was up a little bit. I'm not saying gold should be bought. I'm just saying don't pretend that it's something it's not. Cryptocurrencies are a risk-on asset. They crater ahead of the market and they rip higher, leading the market. Just make sure you understand what you own. Okay, I own a little crypto. Right? I don't own it in the portfolio now. I might buy it back. Who knows? But I'm just saying it's not a risk-off asset. Okay, if the market craters, you're going to get buried in your crypto. Period. Until you see different, right? Then you can talk to me about it. But that's exactly what happens. That's all I'm saying. So from a positive side, Bitcoin's up 5% right now. MicroStrategy bought another 7,000 Bitcoin. I mean, so there's a lot of big guys coming in, buying this most recent dip, right? And let's take a look at just the crypto miners. First of all, BITO. I don't know if it's going to reflect. So it's all the way down here, but it's up 5% on the morning, right? So the Bitcoin ETF is up a little bit here off of that massive decline, right? That's not what I wanted. BLOK. So I have this on my list because look at that beautiful pullback to the 50-day moving average. This is a stock I could be buying right down here, right? These are all the crypto miners. They blew out. They pulled back. If they hold up at the 50 and give us a risk-on buy signal, we'll add that back to the portfolio. All right. So wanted to just mention, follow your crypto and see how it's trading. It's been a lead indicator for the market. Let's see if that continues. Volatility. Volatility tends to spike. This is my last thought here, and then I'll answer any questions you might have. Volatility tends to spike every now and then immediately go back down. So what happens is people, are dreaming about this period here. Oh my God, if I owned VIX, I would have made a fortune. That's true. But then you would have given that fortune away the rest of the next year and a half. Okay. Because every time it spikes, it's literally done. It spikes, it has a couple up days, and then the whole thing's over. All right. So this could be the beginning of a spike that lasts a little bit longer. I mean, it only happened for a tiny amount, right? Look at these little spikes in here. Couple days. So there could be another day or two in here. It's possible, but it doesn't mean anything right now. And instead, what happens is it becomes fuel for the Vanna trade. If the pandemic fears subside and VIX starts coming down, puts are being sold, this drives the market higher. So that eventually is a tailwind. So we had VIX sitting at such a ridiculously low level that we were running out of VIX fuel, right? So let's throw in some pandemic fears, jack VIX up for a couple of days, and then have VIX sell off for the next month as the market makes new highs. I'm just saying there's a higher probability that happens than the probability that VIX is going to skyrocket because there's a new pandemic. All of what I'm saying is subject to change, okay? I don't fall in love with my own voice and my own comments. I don't have an ego about this. I'm sharing with you where my head is as I sit down at the trading desk this morning, and then I read and react to what happens. So take it for what it's worth. I hope it helps you today as you're trading. I will be looking to buy weakness this morning. Market's going to gap open over 1%, okay? And then what I'm expecting is a test of the gap. That usually happens It may not this time because we had such massive selling. This could be a gap and go Monday, which would be surprising, but it's possible. Typically, you'll get the gap, you get the run for half an hour, then you pull back and test. And if that test holds and we go back above VWAP, I'll be putting my long trades on there. All right. So that's how I'll be trading this morning. Happy to take questions. Anything you got for me? CCJ. All right. Let's take a look at uranium. Uranium cratering through the 50. Okay, on the half day. Means nothing to me. If it can recapture the 50-day, we can think about adding uranium back to the portfolio. CCJ has come back in below the 50-day, right? So if it can hold here and reverse back up and set up a nice pattern, we could always get long again. Pritzker is going to be up big this morning, right? I think I read something about something they're doing. Put that on the list. TSEM. Power semi, yeah, coming back down and testing the breakout. It actually looks pretty good right there. Let's look at SOXL, which is the triple semis. I mean, I'd love to get another shot at the semis. They're not even down that much. AMD barely sold off. Wow. Wow, that's a bullish move on AMD and NVIDIA. They didn't even know the market was down Friday. Box, nothing wrong. Oh, so let's just look at MSOS. Oh, yeah, I meant to discuss this. So there we are at the possible low. Okay, this is very important. We're going to get some vote in the next day or two. Maybe it's today, if the story comes out that they've taken cannabis, the Safe Banking Act, out of the the NDAA reconciliation bill or something, whatever it's called. This is going to go back down, probably go back down, take out the stop is my guess. So the stop for me is right here. You have to be willing to accept this risk, right? So if it takes out this low in here because whatever we're hoping, which is a Safe Banking Act that somehow makes it through Congress, if that doesn't happen, they're going to take this out, drive it back down, and we'll have the last bout of tax loss selling. If it does happen, this thing skyrockets. And so I have a partial position on it. I got a partial position on it. The thing gaps down because it doesn't get past. It's not going to kill me. It's not going to ruin my year, right? But if it skyrockets from here, I'm going to want my first piece on, and that's what I've got going on MSOS, just to make you aware of that. Energy stocks. Oil had a 13% decline on Friday. Let's take a look at the energy stocks, Mo. Look at XLE. My first thought on energy stocks is the weakness in energy will maybe give me my shot at owning all of the pipelines I want to own. So now Enbridge is all the way back down to the 200-day moving average. AMI, I might have to double that position. It's coming down a little bit more. WMB, right down to the 50. Oh, geez, I forgot to mention our fourth portfolio. You guys still hanging on, wondering what that is? The fourth portfolio is our dividend portfolio, right? So we have a portfolio of dividend stocks. And so weakness in energy makes me want to buy dividend stocks in the energy space. But I have no interest in buying energy stocks per se. I'm looking for stock. My whiteboard is going to be full of names that have open-ended upside based on, and this is the key, based on monopolistic type tendencies of the company. They have a high moat around the business. They have intellectual property nobody can attack. They have high margin business, right? It's got nothing to do with worldwide economics or whether or not Saudi Arabia is going to release more energy or whether or not, Joe Biden decides to, dump, oil on the market. I don't care about that stuff. I don't want that stuff in my portfolio. I only have so many stocks I can buy, and I want to buy something that has such a dominant market position with high margins driving massive growth. That's what I want in my portfolio. All right. So I'm not buying any energy stocks because that just doesn't fit the bill. It doesn't fit the bill for me. You can go do it. Feel free. I'm telling you, but what I do with my money, if I go back and look at the last 30 years of running my own capital, running capital for clients, the greatest successes are identifying the open-ended growth opportunities, putting them in a portfolio, picking them off right, and having them go through the roof. Illumina is one of my favorite examples of that, right? Paid $3.50 for the stock, and you all know where the stock's trading now. I mean, the stock's gone through the roof over that time period, 20-year time period, right? Having split a number of times, okay? Because they dominated a niche. Nobody could do it with a business model of a razor blade business model. Once they got the razors out there, the blades started to sell, the margins skyrocketed. I mean, it was a no-brainer story. It's hard to find them. But if we work real hard, we can fill up our whiteboard with those names, and then we use the algorithms to find entry points when the market's right, put the money to work, skyrocket, hopefully some of those positions we hold on to and make a ton of money. That's that portfolio. My other portfolios, I'm day trading, I'm swing trading, but that portfolio needs to be full of names like that. And energy stocks never make it. They just go through crazy cycles. Okay. So what I do with energy stocks is I use the dividend payers. Okay. So when I get weakness in energy, what I want to really buy is, I've been having my eye on CVX forever, and it's not down enough. It didn't go down enough. If CVX comes down in here, I want to buy it again. All right. It didn't do it. But maybe I'll get the pipelines down here. An oak. Well, they're barely down, but I could probably buy one oak at the 50-day if I wanted. That's what I would do. What else we got here? Yeah, I was reading about mRNA, so the stock's up $40. I mean, this is all over the place. I want to find an entry point in here, but as you can see, there's massive gap downs, massive gap ups. This is just not the right chart pattern for me at the time. So I mean, quite frankly, the best position we've held on to through thick and thin, is our Pfizer position, and it just keeps going up. And I wish I doubled it down here. I took a position here, booked some profit here, it came in. Boy, I should have been doubling it there. And then the thing is just skyrocketed and paying us 4.5% yield. So in my dividend portfolio, I haven't sold any of it. In the dividend portfolio. Bought it with a 4.5% yield and left it alone. The stock's going through the roof. It's the great. I mean, that's how you want to build a dividend portfolio. You only need a couple of those names to pay for the other dividend guys you put in there that, the stocks don't go anywhere, but you get paid your dividend. So yeah, mRNA is through the roof. See, Chinese manipulate the iron ore market. You're talking about, Mo, you're talking about things like BHP, right? You got fat dividends there in Rio Tinto. Yeah. I mean, as a dividend play, I could see those names, but the charts just look terrible. And what really bothers me is we have to watch what we're putting in the dividend portfolio. We don't want to put something in there where Chinese can manipulate the market and crush the idea. It's just the dividends are great, but the positions keep getting sold. So until we get a real bottom that sets up in those stocks, I don't know. I don't know if I want to own them. I just don't know. The pipelines here in the U.S., I don't care what happens in the world. Those pipelines are a cash cow, and no one's going to stop using natural gas and energy right now. So I can keep collecting those dividends. I can see that. But if China can totally trash a particular, commodity for whatever reasons, and it ruins the stocks, I can't have my dividend portfolio there. So that's why I haven't bought those for the dividends. Here's a stock I really like to add to the dividend portfolio. It's Lumentech. I haven't done it yet, but when I listened to that conference call, boy, that dividend is 7.5% is money good. It's money good over the next couple of years. So I'm just looking for an entry point there, really. All right, so if that's it, I'm going to split here. I got to see you guys on the live trading desk, which will start as soon as I'm done with this. I'll go set up the YouTube exclusive video for the live trading desk. participants. So I'll see you over there before 9:30. And the first thing we'll do is look at the spot gamma levels on the indexes so we know how we want to trade today, okay? Where we want to look for reversals. So I appreciate your time with me this morning. I'll see you all in the Slack room and on the live trading desk in a few minutes, okay? Everybody, make sure you stay nimble out there. Don't fall in love with your own ideas. Stay nimble. Protect capital, okay? Take care, everybody.